Okay, so let's jump into creating a plan to freedom. And the starting point for property investors really deal analysis. Now, one of my students is on the call. His name is Tian. And this is something that I find he's done incredibly well. Is he's an analytical guy, he's risk averse, he doesn't like to make mistakes, he loves to understand what investment decision he's making from a financial point of view, not just it feels right or it seems right. Okay, and that's why he's going to be successful. So starting with deal analysis is you have to understand that there are two key strategies in property. You've got your cash flow strategy, you've got your cash strategy. Your cash flow strategy on the left-hand side is when you buy a property for holding purposes. This means you buy it and you're going to hold it for 5, 10, 15 years, and the rent should cover the expenses. If the rent is greater than the expenses, you're left with a positive cash flow. If your rent is less than your expenses, you're left with a negative cash flow. So that's the cash flow strategy. On the right-hand side, you've got the cash strategy. This is where you're buying a property at a discount, forcing the value of the property to go up by, maybe renovating it or making it more attractive, and then selling it for a profit. Now, these deals are usually 3, 6, 9 months long. You buy, you fix it up, you sell. It's classic. In our property world, the jargon it's called the flipping strategy, where you're flipping a bad house into a good house for profit. Now let's look at the cash flow strategy in a little bit more detail, because I saw in the polls that this is where people are mostly interested in. So very simply, you get monthly expenses associated to every property that you buy. These expenses could be your bond payment, your levies, your rates and taxes, your insurance, your water and electricity, etc. Then you also get a rental income for the tenant that's living in the property. If your rental is greater than your expenses, you're left with a positive cash flow, also known as monthly profit. So you can either increase your monthly profit by increasing your rental or decreasing your expenses. Increasing your rental, this is one of my strategies, is I like to increase the rental by putting multiple people into a property. So instead of buying one house for one tenant, I'll buy a bigger house or a block and put in multiple tenants, because that's a great way in which you can enforce the rental amount to go up, which means you're going to have more income, your expenses don't really go up, and you get to walk away with some cash flow. So I thought, let's look at a live deal so that you can actually, really understand this concept. So here's an example of a buy-to-let. It's a 2-bedroom apartment for sale in Berea, Johannesburg. You can see that there on the top left that the asking price for this 2-bedroom is 385,000 Rand. All right, so if we break down basically the description that the estate agent gave us, you can see here that the estimated levy for this block is 1.6 thousand, and the estimated rental is 8.5 thousand. All right, and there's some other interesting information there that you can see. But key, we want to know is how much the rent, how much the income is, and how much the expenses are, because then we can work out the cash flow. So if we run the numbers on this deal, you'll see that the asking price is 385. Purchase at 320. Remember, we have to buy at a discount, right? That's why I believe that, as much as this COVID situation is pressing now and it's maybe uncomfortable for a lot of people, at a later stage in the next couple of months, if you play your cards right, you will be able to get into the property market at a cheaper price than 6 months ago, because COVID has eroded some of the property market, and it's a short-term erosion, right? That's the thing. In 6 to 12 months' time, when the economy comes back into full swing, the property prices are going to pick up again. But people are going to make long-term decisions based on short-term fears. That's an opportunity for us. So the rental is 8,500. Monthly bond. So that's the amount that you're paying back to the bank, right? So you're going to loan 320,000 from the bank, and the bank's going to charge you 3,194 Rand per month. Another great thing about the COVID, just on the side note, is that our interest rates have gone down by 2.25% in one short space of a year. That is incredible. That is going to have a huge impact on our deals and making them more profitable. The levies, as we saw in the previous slide, is 1656. Provisions and monthly profit. So assuming that these numbers are correct, I will walk away with 2,800 Rand per month as a profit from this deal. So the question now is, how many of these deals do you need to be financially free? To never have to work again, how many of these deals do you need to do? Right? And this is where My Property app comes in. That's the sponsor for tonight's webinar. This is an online deal calculation tool, and what they've done is built this incredible software that allows you to analyze deals online so that it takes away the guesswork. You don't have to worry about it anymore. So if you are interested in that, go check out www.mypropertyapp.online. I'm going to just ask Apollo to put that in the chat bar, a link to that website. You're welcome to get yourself registered for a free trial. So now that you understand the basics of cash flow, we need to jump into how can you create a plan towards freedom. Okay, now if you do have a pen and paper nearby you, that's great. If you don't, quickly go and grab one, because we're going to get a little bit more practical in the workshop today. So first of all, what is financial freedom? Now the guy on the left here is a financially free dude sitting on the beach and enjoying a cocktail while the money is flowing in. Now what financial freedom means is that you have enough passive income, i.e. income that works without you having to work. So rental property is a great example of that. You know, if you're on the beach somewhere enjoying your time, but your tenant is still paying their rent, that means you're getting a passive income because that tenant is paying you every month regardless of what you're doing. Once your passive income equals your monthly expenses, you know, your medical aid, your transport costs, your clothing costs, your credit cards, everything. Once your passive income equals or exceeds your monthly expenses, you are financially free, which means you don't have to work, you choose to work. Now, does anybody resonate with that? Is anyone excited by the idea? Maybe just put an I in the chat bar if you are, if you're seeing some value and some excitement. And I'm seeing some chat bar, I'm seeing lots of eyes in the chat bar. People are excited about that because the prospect of leaving your job because you've got a stable property portfolio and you can then follow your passions or pursue your hobbies is very, very exciting. So how do we set now a financial goal so that we know exactly what you need to be doing to reach financial freedom? So step one, and this is where the notepad comes in, please can you write down on a piece of paper how much your monthly expenses are today? Now, when I say monthly expenses, I mean everything from a monthly point of view, right? So your insurance, your car, your petrol, your kids' school fees, your home loan, anything that you have on a monthly basis that is an expense. So basically, what is that figure? Okay. Essentially, if you had to lose your job tomorrow, how much would you need coming in per month so that you didn't have to go find another job? What is that minimum basic amount? Okay, let's say that, you know, I'm using the example here of 20,000 Rand. Yours might be 30,000, it might be 80,000, it might be 5,000. Doesn't matter, everybody's on their own journey. Now, once you know what your today value is, you need to determine what that value is going to be worth in 5 years' time. Because remember, over time, especially in 5 years' time, the Rand value of your 20,000 today won't have the same value in 5 years' time. So although you can buy all your groceries today with 20,000, in 5 years' time it's going to take you 25,000 Rand to pay for everything, right? So here's a very simple formula. It is taking into account a natural inflation rate of 6.5%, but you take your value, be it 20,000, times 1.37, right? Or your value, 30,000, 80,000, and that'll give you your financial freedom figure in 5 years' time. So what this is saying is that if I need 20,000 Rand today, in 5 years' time I need 27,500. Okay. Now what we've done is we've worked out our financial freedom figure, i.e. how much money we need coming in passively per month to never have to work again. And now we're going to have to create a plan. So strategy time. Remember, I've said that the cash flow strategy is one of the most powerful strategies because that is where the passive income sits. So when you're looking at that kind of strategy, you've got essentially two options. You've got your buy to let, which is on the left-hand side, one house, one tenant, or you've got your multi-let, which is on the right-hand side, that is one house, multiple tenants. Now, on average, I've seen that most buy to lets, if you buy them at the right price, you can probably make about 1,000 Rand per month cash flow. And on the buy to flip, on the multi-let side, I've seen an average of about 6,000 Rand cash flow. Okay. So using those basic parameters, we can work out how many properties you need to buy in order to reach your freedom figure. So remember, I had the financial freedom figure of 27,500. Now, if I wanted to follow the buy-to-let strategy to reach 27,000 Rand cash flow, I need to buy 27 buy-to-lets, right? If each one is on average bringing me 1,000 and I need 27,000, I need 27 buy-to-lets to get me to my financial freedom figure. Now you can do the same thing. Whatever your figure is divided by 1,000, and you know how many buy-to-lets, i.e. 1-bedroom, 2-bedroom apartments you need to purchase to reach your freedom figure. Now over a 5-year period, I might buy 6 in the first year, 6 in the second year, 6 in the third, 6 in the fourth, and then 3 in the 5th year. Okay. Multi-let strategy. Now this is why I like the multi-let strategy. I would only need to purchase 5 properties to get to the same income goal as multi-lets. And that's why I choose multi-lets, because it's a quicker way to achieve your freedom. Okay. Now we have to look at the practicality of do you have the resources to be able to do this? Now, if we look at the buy-to-let strategy, you know, that Berea deal is a perfect example. You know, your average deal is going to cost 300 to 350,000 Rand. So you're going to need a deposit for each one of those deals, right? You'll be able to get a bank loan, and the bank will possibly loan you 90% of the value of the property, but you still need the other 10% to, you know, cover the costs and some of the buying transactional costs. So let's assume that for those 27 properties, you need to put a 10% deposit of 30,000 Rand for each one of those. That means the capital you required to build this property portfolio is 810,000. Okay, if you divide that by 5, it basically means over the next 5 years, you need to invest 162,000 Rand into your property portfolio in terms of buying properties, raising capital, earning more in your income, and saving more so that you can get to that 810,000 Rand figure and buy the 27 properties. Okay, that's the kind of level of detail I want us to get to. So you need to know exactly how much money do I need to save per month, how many deals do I need to do per week, how many, you know, estate agents do I need to meet on a monthly basis to really make this real. If we look at the multi-let side, 10% of a 1.5 million Rand multi-let will be 150,000 Rand, so the capital required to do that strategy would be, you know, 750,000. Okay, so that just gives you a little bit of a sense of how many properties you might need to buy and how much capital you're going to have to raise in your personal name to be able to make this business happen. And raising finance, I can tell you, that's one of the key skills. Once you master that, you can truly call yourself a property investor. Okay, next we've got area research. So we've looked at deal analysis, how to analyze does a deal make financial sense or not. We've then created a plan to see how many properties do we need to purchase and how much money do I need to raise in order to reach that level. Now the third step is, what area am I going to target? I.e., you know, am I going to be investing in Cape Town or Durban or Johannesburg, or am I going to be investing in Berea or in Woodstock or in Umhlanga? You know, you need to find the area that you're going to invest in and then focus on that area. So this is one of the most important slides for me, because this justifies why multi-lets are definitely the best investment. What you can see here is the average of the South African population in terms of how much they pay for rent. So you can see right at the top there, 25,000 Rand or more, only 1.6% of South Africa's population spends more than 25,000 Rand on rent. Right? The important thing to note here is the 2 bars at the bottom, the 3,000 to 7,000 and the less than 3,000 category. Now what you can see is if you add those two together, you're sitting on about 70 to 75% of the population that rents between the price band of 3,000 to 7,000 Rand. Right, now that is one of the most important considerations, because I need to have a big market to rent to. Right, supply and demand. If I've got a high supply and a low demand, it means I'm going to struggle to sell my property, I'm going to struggle to rent my property. If you've got a high demand, low supply, you've got the exact opposite situation. So that's why I like to target low income areas, because I know that that is where the greatest need for housing is. Now, one of the questions that Tian asked, which is a fantastic question, was regarding, you know, how am I going to mitigate my plans from this coronavirus, and how has it affected my property portfolio? And the truth is because I'm renting to to lower income earners, I am seeing a huge drop in my income collection, because the people I rent to are people who earn a living day by day and earn a living by going out and performing a job where they have to be on the job to complete that task. They're not online remote. They can't work from an online remote location. So yeah, I've seen about a 40% drop in my income recovered. I think the strategy that you need to focus on is just survival until this whole thing blows over. I think we're in unprecedented times. No one could have seen this or predicted it. What I can say is that I always analyze my deals to make sure that I have a 20% margin, which basically means that even if I lose 20% of my income, the deal is still cash flow neutral. So because I've done that, and because there's been a substantial drop in the interest rates from the South African Reserve Bank, I'm actually, of the 40% that I'm not collecting, I'm actually only losing maybe 10% in total, because of good buying principles of buying below market value, making sure that the deal makes a lot of financial sense so that even in tough times it succeeds, and then the drop in interest rates has actually protected me quite a lot. Okay, let's say that you're looking to invest in beautiful Cape Town, right? This is a key slide that you need to be aware of. Now, what this slide is telling you is basically what the best area to invest in is. The blue bar is telling you the average capital growth. So what is the value increase in the property month on month? And then also the green is the residential or the rental yield. So if we look at Greenpoint, for example, now Greenpoint is a fantastic area. It's a high income area, sea facing view. It's where the who's who of Cape Townians want to live. Now you can see that the blue bar is sitting at 12.5%, which means there's a lot of capital growth. There's a lot of people wanting to live in Cape Town. That is telling me that it's a good capital flip area. It's a great place where you can find a rundown apartment, fix it up, and sell it to a prospective buyer. Because there's a lot of buyers coming into the market, because there's a lot of capital appreciation or a lot of investors coming in, it's a great area to do the flip strategy. But you can see the green bar, which is the rental yield, is very low, which basically means you're not going to find a property where the rent is more than the expenses. So it's not going to be a good rental area. It's not a place where you must be focusing cash flow attention. Right, if we look at maybe an area like Aruna, which is in the middle of the page, you can see that there is a slight capital appreciation of about 6%, but then there is a 10 to 15% rental yield. That is an area that I would be interested in exploring if I'm looking at the cash flow strategy. And then finally, the red indicators are telling you the risk in terms of a default tenant. Okay, now that's very important. When you're analyzing a deal, you have to put in a vacancy provision. You have to make sure that the numbers still make sense even if the property is empty for 2 weeks, 2 months, 6 months. It depends how risky the area is. But make sure that you've got that number analysis. Maybe you prefer to invest in the City of Gold in sunny Jozi. This is a great slide because this is going to challenge a lot of people's mindsets. On the left-hand side, you can see a place called Berea and Hillbrow. Now, traditionally, I used to think of Hillbrow and Berea as very potentially dangerous areas. I've heard a lot of stories, and I'm not sure if you've had that same experience. Maybe you haven't. So I always thought it was a risky place to invest, and actually, when I looked at the stats and the data, you can see it's probably one of the best places to invest. Right, the capital appreciation in the two areas is quite low. It's hovering between 4 to 6%. But look at that rental yield. That basically means half of the deals that you're going to look for in Berea, the rental is going to more than cover the expenses. Guys, that's fantastic. And what's also great is the rate is quite low. You can see you're looking at a maximum 5% delinquency rate. That means 5% of the time you're not going to get an income, but 95% of the time you're expected to get an income. That's fantastic. Then if we look at the areas surrounding Hillbrow, you're looking at Bellevue and Yeovil. Look at how high risk those areas are. Look at how red that is. Those are things we've got to consider. And these are changing variables, right? In 5 years' time, Hillbrow might be a bit more of a red area than Yeovil, those are also things as the market starts to progress. You need to look at the trends. You need to look at this year's, last year's, and 5 years ago, what the different delinquency rates were, and create a trend of where this is going. If you're looking at again, Johannesburg, Pretoria in the Gauteng region, here's another slide that shows you Centurion, very safe area. You can rent and you can do flipping. Boksburg is also a good area for rentals. If you're looking at Soweto, there's lots of deals there. There's lots of potentials, but you've also got quite a high delinquency rate. So within Soweto, you've got pockets of good areas and pockets of bad areas. You need to become a specialist. You need to know which areas are high in terms of risk and which ones are low in terms of risk so that you can make an informed decision. Okay, so you found your area, you've analyzed your deal, you know you need 27 properties to get started, and you've analyzed, you've put your offer forward, and the estate agent says, yes, we are going to accept your offer. Now what? Okay, this is where you have to sign an offer to purchase. This is where you're making essentially a signed agreement with the seller that you want to purchase their property at a certain price. Right? Now, the offer to purchase is legally binding. It's a document that legally binds the seller and the buyer towards a transaction. It must meet suspensive conditions to be valid. Okay, now that's very, very important, and if you want to, you're more than welcome to make a note of this. A OTP is a way in which you can secure a price with the seller. Okay. It's a way that you can secure the price with the seller. Now, what you can do is you can put some certain suspensive conditions into the contract that if those are not met, the deal falls through. Now, this is very important, ladies and gentlemen, because I can tell you now the hardest part of property is finding a seller who's willing to sell a property at a discount. So usually what I do is I'll have anywhere between 5 or 10 offers on the table at any one time. So as soon as I see a deal that I like, I will then sign an offer to purchase with that person to secure that deal at that price. But I've got 5 or 10 different offers going at the same time because I know I'm going to get a lot more no's than yeses. I'm probably going to get 20% yes and 80% no. Now what happens if I've got 3 or 4 offers that come that are accepted at the same time? Well, that's where I can use my suspensive condition to get out of one of the contracts so that I can pursue the best one of those 4. Does that make sense? So the key thing to note is that you use an OTP to secure a price, you use suspensive conditions to exit or to have a way to exit out of any kind of contract. Okay, you must have an OTP if you want to raise institutional financing, which is a code word for the banks. If you want to go to like an ABSA or an FNB, you need an OTP to raise any kind of money from them. Now let's look at suspensive conditions. One of my favorite suspensive conditions is you can say this offer is subject to getting and accepting a builder's quote. Okay. One of the biggest challenges that I have with my students is they don't know how much the renovation of a unit might cost. So why don't you put an offer forward for 300,000, and in the offer you say this is subject to my builder coming in the next 2 weeks to come and look at the property, quote it, and as long as the quote falls within my guidelines or within my budget, I will continue with the purchase. But if for some reason the builder sees there's some damp work that needs to happen on the roof and that's going to cost me extra 30,000 and it kills the deal, then I want to reserve the right to exit the deal. So that's a great one. Subject to acceptance of a builder's quote. Subject to partner approval. That's a great one because it's so vague, you know. Your partner could be the cat that you have at home. Your partner could be your best friend. Your partner could be your spouse. You know, and if your partner says for some reason no, you can just go back to the estate agent and say, sorry, you know, my partner rejected the offer. A great way in which you can exit a OTP. I just want to make sure that you guys are also with me here. Please don't use these suspensive clauses just to irritate and frustrate estate agents. Right? Make sure that the only reason you're using these exit clauses is not because you're trying to get out of the deal, but so that you have a way to get out if need be. So go into every deal assuming you're going to buy this property, put everything into it, put the offer in, and just use this as a way to get out if something terrible happens, like, you know, maybe you lose your job 2 weeks before or 2 weeks later and you want to be able to get out of that deal. That's the reason to have a suspensive condition. Another firm favorite of mine is a subject to 2-week due diligence period. So basically that's saying, I'm happy to offer you 300,000, but for the next 2 weeks, I want to be able to come and view the property with my builder, with my architect. I want to be able to pull the relevant reports so that I can see, what's happening in this area. I want to meet the tenants. I need 2 weeks to do a deeper dive into this deal. And if after 2 weeks everything checks right, I'm happy to move forward. So that's a great, great suspensive clause. Another one is subject to raising finance. My advice here is be very, very specific. So don't just say this deal is subject to getting a loan from FNB, because if FNB does give you a loan at an interest rate of prime plus 10, because you haven't stipulated it in the document, they might expect you to accept that. So I always just say it is subject to raising of X percentage LTV. So I need 90% loan to value at an interest rate of prime minus 1, or anything below prime, something like that, just so that you've got a way to get out of it if you don't raise the financing. Another one, if you're in a riskier area and you've got some bad tenants that are currently occupying the property, you can make your offer subject to the current owner having to evict the tenants. The point here is that you can put anything you want. You can say on subject that the owner removes the curtains, that the owner repaints the property, that the owner leaves the fridge, that the, whatever it may be, that the owner, gives you their puppy. I mean, I don't think they'll do that, but, the point is anything you put in this contract that isn't met allows you to exit. Okay, so sure, we've gone through a lot, and I hope I haven't bored you too much, but we've looked at deal analysis, we've looked at creating a financial freedom plan, we've looked at area analysis and knowing what is a good area versus a bad area, we've looked at offer to purchases, how to secure a deal at a certain price. Now we need to look at the next step, which is you're actually making a purchase of a property now. How are you going to structure this business? Are you going to buy it in your personal name? Are you going to buy it in a company name or in a trust? And what are the benefits of these different areas? So the options, as I've mentioned, is 1, you can purchase a property in your personal name. Okay. Number 2, you can purchase it in a partnership. So me and Tian, for example, we open up a partnership together, and we go and purchase a property. Him and I are both 50% shareholders. That's an example of a partnership. A company, this is where me, Safiso, Tian, and Nadine come together and we buy a property in a company structure, and then number 4, in a trust. Okay, so let's look at all 4 of these in a little bit more detail. Starting with your personal name. Now, one of the great benefits of your personal name is that you get a 2 million rand tax exemption. So let's say you buy a property for 1 million rand, you sell it for 3 million rand, and you make a profit of 2 million rand. That profit is exempt from capital gains tax up until 2 million in your personal name. So my, a pro tip in this regard is if you're looking at flipping a property, do it in your personal name, right? If you can prove that this is a property that you have bought, lived in for at least 6 months, and you can flip it, you can get a 2 million rand tax exemption on it, which is fantastic. So if you're looking at doing your first flip, do it in your personal name. It's easy and cheap, right? You don't need to set up a company, you don't need financials, you don't need an auditor, you don't need any of those fancy things. You basically just need to make sure that SARS knows what your income was for the year and pay your personal tax. So it's easy and cheap to set up. There is an increased liability. Of course, if you do a property project in your personal name and it goes wrong, they can then target anything else that you own in your personal name as collateral. So they'll come after your car, your wedding ring, or whatever other asset that you might have. They will be able to use that. And this could be a positive thing or a negative thing, but you get taxed at your personal tax rate. So if you're a low income earner, maybe it's a good idea to start your property portfolio in your personal name, because you're going to be taxed at a lower rate than a company. If you're a high income earner, all the better reason to put it into a company name. If we look at the partnerships, now what's great about a partnership is you have resource sharing. So Tian, for example, is very, very good with analyzing deals, very analytical, whereas Safiso has got access to a lot of capital. Now those 2 guys can come together and make a formidable partnership. Safiso can bring the capital, Tian can bring the knowledge, and he can maybe bring the project manager and the builders side of things, and together they can group up their skills to be able to purchase a property. It's also easy and cheap to set up. I've recently done a partnership with a friend of mine. He brought the capital, I brought the experience, and I brought the deal. We are sharing everything, 50-50. We've got some simple financials that we put together, and it's a really easy, cheap way to get started. It's got a high liability, because you're in a partnership, it means that you are liable for the full amount, so if you're loaning R1,000,000, 500,000 by Tian, 500,000 by Sifiso, if Sifiso or Tian does not pay or can't commit to it, then it falls onto the other person's shoulders. So just be aware of that. That's quite a negative point. And trust is crucial. I really don't recommend that you get into a partnership with someone that you don't know or trust. I essentially see partnerships as a marriage. You wouldn't marry someone that you barely know or trust. Make sure that when you get into a partnership, it's someone that you do truly trust. Company, okay, limited personal liability, which is great. You get to separate yourself from your company, and only the assets within the company can be targeted by the banks. That's a very, very big positive. The profit is taxed at a flat rate of 28%. So if your personal tax rate is lower than 28%, it makes sense to invest in your personal name. Once it goes above the 28% bracket, putting it into a company would make more sense. It's hard to get the money out, so as much as your profit is taxed at 28%, your dividends is then taxed on a further, I think it's 18%, I stand under correction. But basically, in order to get that money out, you're going to pay an effective tax rate of 41%, because you're going to have to pay your profit tax, plus you're going to have to pay your dividends tax. I am obviously willing to introduce anyone who has got more technical questions about accounting to my accountant. I'm just giving you a bit of a high level view here. Company, it's hard to raise finance. This is because you'll either need 3 years plus of track record before a bank will load money to a company. What you can do is you can take personal surety for the company. So what that means is that you get a loan in the company, but if something goes wrong and the company defaults on the payment, they will still come after you as the individual. That's the way you can get started for the first 3 years while you're building a track record in your company, and then once your financials are stable enough, you can then apply for a loan through the company. My opinion is a company is very good for trading. So if you're doing 1 or 2 properties, do it in your personal name, do it in a partnership. Once you start flipping properties on a regular basis, or you start buying regular blocks of flats or regular buy-to-lets, my recommendation is to put it into a company. It's a good trading mechanism for property investors. Lastly, we have the trust. Now this is I'm going to spend a little bit more time on, because I know people are very interested by the idea and the concept of a trust. So a trust is fantastic for legacy planning. Now, there are different schools of thought here, and I definitely don't profess to be an expert in trusts, and this is just my personal opinion. But I think a trust should only be used for long-term wealth planning or estate duty planning, not for anything else. Now, the good thing about a trust is that if you pass away, the trust lives on. That's the key thing to know about a trust versus a company, partnership, and personal name. Now, why is that important? Well, let's say Sifiso buys a property. It's worth R1,000,000. He then passes away, and his son wants to now inherit that property from him. If he bought that in his personal name, before his son can access that property, he's going to have to pay SARS an inheritance tax, which is roughly 30% of the asset value. So the asset's worth R1,000,000. Sifiso's son has to first come up with R300,000 before he can access that property. That's crazy, right? But if it's in a trust, Sifiso's son doesn't have to pay anything. He just has to be a beneficiary of the trust. He then takes over the trust. The trust lives on even though Sifiso dies. So that's the great positive of a trust. It's good for legacy planning. It's got great high protection, right? When it's in a trust, and something goes wrong in the trust, they can't tackle your personal name, they can't look at your partnerships, they can't try, and they can't associate any other collateral to it. When it's in a trust, it's safe and secure. It's very, very highly taxed, and it's highly complicated and expensive. The tax on it is 40% plus, and to manage a trust is at least R1,000 per month. So if you've got a massive portfolio, yeah, maybe you can put them in a few trusts. But if you're starting out, put in a company name, and once you start planning for legacy or estate duties, when you reach maybe an older age, or you start to feel that retirement is around the corner, that's when you're maybe going to set up a trust, transfer the shares of your company into the trust, so that at least if you pass on, the company can continue. And it's costly, especially on a monthly basis. Okay, let's look at some more on how to use trusts. Okay, now I recommend having 3 different trusts once you get to that level, right? Now remember, a trust is useful when you're looking at estate planning. If you're not looking at estate planning, this might be a bit premature. In my mind, you need to have 3 trusts. A personal trust. This is where you have paid off assets. Assets that have no debt. Why is that important? Because you don't want any defaults to happen in this trust. You want to put your personal house, your personal car, maybe your wedding rings, maybe some valuable furniture and belongings, and you want to put it into a trust that has 0 debt, which means it cannot default and it cannot be in any kind of risk. You don't want your personal house to ever be repossessed, etc. So all your debt-free items go into your personal trust. Then you've got a property trust. Now, I would usually recommend that you put 3 to 5 properties in a trust before moving to the next trust. Remember, it costs about R1,000 per month to manage a trust, so you want to make sure that you've got enough income and enough revenue being generated to, validate that kind of cost. And then a business trust. So you can either put your businesses into a trust, or best practice that I've seen lately is that people will buy in a company and they'll have the shares of that company in a trust. So that's, from a tax efficiency point of view, probably one of the best ways. So I know this might be a bit premature in terms of why you would use and how you would use a trust. I just want you to start thinking about this so that when you do get to that level of wanting to plan for your estate, plan for your kids' legacy and their wealth, you've got the basic concept in mind. Okay, next, buy real estate with OPM. Now, I did see on the polls that most people are interested in how to access other people's money, so let's talk about some strategies. Okay, now there are 3 ways in which you can raise other people's money. The one is through institutional finance. These are the banks, right? You can go to the bank, raise money, as long as you've got a good income, a good credit score, and the deal makes sense. Now, if you are an employed person with a decent salary, this is the place I'd recommend you go. It's got the cheapest interest rates and the most access to capital. You're not going to struggle. You're not going to run out of money. Let's put it that way. Now, if you don't have a good salary or a good credit score, you might want to try one of these 2 techniques. The one is a private financer. So this is where you're finding a wealthy individual who will then loan you the money on certain terms. Or you might want to approach, one of the commercial banks, guys like Sentinel Homes and Combined Finance, Tough, Mercantile. These are banks that are run by private wealthy individuals who don't necessarily look at the credit score, who don't necessarily look at your salary, but look at the deal. And if the deal makes enough sense, they will give you, in essence, a business loan. Okay. And then the final idea would be creative financing. And this is where you have to think a little bit outside the box to make a deal happen. Now, I'm just going to share with you a couple of ideas for creative financing, because I want to show you that with the right kind of knowledge and the right coach, you can do absolutely anything. So, creative financing. You've got one idea known as seller financing. Now, one of my students on the call, his name is Tian. I've referenced him already a couple of times. Him and his girlfriend recently did a seller financing agreement. Now the concept is really simple. Okay. Instead of buying a house, why don't you get into a partnership with that seller? Okay. So what you say to the seller is, look, your house is in bad shape. I'm happy to come and spend some money to renovate the property, and then we can sell it for more, and we split the profits. Right. So the house, it's worth, let's say it's worth 1.5 million, but because it's in a really bad condition, it's only worth $1 million. So you come in and you say, I will put 100,000 Rand into this property, renovate it and fix it up so that it's worth 1.5 million. And then when we sell it for 1.5, we split the profits. Now you don't have to buy the house for $1 million. You just have to get into a contractual agreement with that seller that says, in 6 months' time when we sell the property, we split the profits 50-50. You don't have to buy the $1 million. You don't have to have access to the $1 million. You got to get access to the 100,000 Rand to pay for the renovations, to force the value up. and you need to make sure that you've got a good contract in place between you and the seller, but you are not required to put money down to buy the property. Does that make sense? That's a really creative way in which you can make use of the property without actually buying that property. The back-to-back strategy, I'm going to show you a deal on that one, the rent-to-rent and lease options. So let's go through the rent-to-rent one. I know I've shown some of you guys, if you've been on the webinar before, you would have seen this strategy, but it is such a powerful one that it's worth repeating. Now, the rent-to-rent strategy is essentially you rent from an owner and you sublet to many people. Okay, so you don't have to even buy a property to make use of the cash flow of that property. Like this student, his name's Ezra. He found this Airbnb or this bed and breakfast that was underperforming, spoke to the owner and said, listen, I'll rent out your entire bed and breakfast for a certain rate, but then what I'm going to do is I'm going to go and outsource it to all these different students. Right? So this is what it looks like. It is currently furnished as a bed and breakfast, but it can easily be converted to student accommodation. Actually, let's be honest, it's pretty much already ready for a student to come in. Now, the numbers were very interesting. He agreed a 65,000 Rand rental to his students, right? 17 students, each going at 3,000 Rand. He's making 65,000 Rand income every month off this deal. He's only paying the owner 30,000 Rand. So he's renting from the owner for 30,000 Rand. He's subletting to the 17 students at 65,000 Rand. He's got a whole bunch of other expenses, and he's walking away with a cash flow of 12,000 Rand. How much money did he need to do this deal? Probably about 60,000. He needed to put 2 months worth of rental down as a deposit. That's pretty much what he needed to do. So the owner said to him, give me 60,000 Rand, i.e. pay for 2 months up front, you can have access to the property. Guys, it's not always about you need millions and millions and millions. Sometimes you need 20, 30,000. Sometimes you need 60. Sometimes you don't need any. And that's where the back-to-back deal comes in. Now, the back-to-back deal is essentially a no money down deal. It requires you nothing to get started. Right, so this is my colleague Leroy, and he did a back-to-back deal on this property in the background. The agreed purchase price of this property was 350,000. No refurb costs. The attorney charged him 8,000 Rand to do the transfer. So he's in the deal for 358. He sold it for 520 and made 162,000 Rand profit. Now, let me explain to you how he used none of his own money. Okay, so what he did is he signed an offer to purchase. Remember, that's that legal agreement with the seller that said, I will buy the property for 350,000 Rand. And then he put a suspensive clause in place and he said, this is on condition that I can get 3 months to access the capital. Now, the owner was really distressed. They wanted out of the deal, so they accepted his terms. So they basically accepted that Leroy's going to buy the property for 350,000, but they have to give him 3 months to get the money. Within that 3-month period, Leroy then went to go and find a prospective buyer. So he found these 2 brothers who wanted to live in the area. He signed an offer to purchase with them for 520,000 Rand, and the money from those brothers was then paid into the seller's account. So you can almost see him like the middleman. He was essentially bringing 2 parties together. He was introducing the seller to the buyer, and he was taking a finder's fee for the work he's done. Does that make sense? Now, there are some rules and regulations in the Estate Agencies Affairs Board that says whenever you're earning a commission off a property transaction, you have to be registered with them. There are ways in which you can legally do this, but you do need a good property attorney. So if you do see an opportunity to do a back-to-back, give me a call. I can introduce you to my property attorney, and he can help you structure it in a legal and ethical way. I just wanted to show you, you don't need money to do property. What you do need is you need knowledge, you need experience, you need a coach. Okay, and that brings me to the last part of this workshop, which was really about how do I get a property coach. And I know that there were quite a few people that had asked some questions leading up to this webinar. So instead of replying to each one individually, I thought I would just, quickly put a few slides together and just talk to you about my Property App's coaching program. So firstly, what is a coach? I mean, your coach is the person there on the right. It's your motivation. It's the guy who's going to help you achieve the results that you want. It's someone who's going to push you and really help you reach higher levels of activity. So the first major point that you have to look at with a coach is they have to have the results you want. Right? You don't want to get personal training advice from someone who eats KFC every single day, someone who's overweight and unhealthy. Similarly, you don't want to take advice from a property investor who has one or two deals and both of them weren't that good. You want to be learning from someone who's got years of experience, who's got a successful property portfolio, who is financially free. That's a key consideration. A coach can show you the quickest path to success because they've taken the path, so they know how to get there quicker than others. Holds you accountable, right? Shouts at you when you don't do what you're supposed to do, because the only way you're going to get results is if you do the sit-ups, right? If you do the push-ups, if you take the action, is where things change. And the key thing is that a coach will never do the work for you. They'll just tell you what to do, but it's still up to you to make your results happen. Okay, the property coaching outcomes of our program, which is my Property Apps program, is the first session. It's all about financial freedom planning. So this is where we spend an hour and a half talking about your specific resources, your level, how many properties you need to buy, and basically creating a 6, 12, and 18-month roadmap on how you can reach your freedom goals. The second session is all about number analysis, so return on investment, return on equity, rate of return. I show you some demos of how to use the My Property app, deal analysis, how to generate investor proposals. So all the numbers we spend on session 2. Session 3 is all about area research, how to use TPN, Lightstone, how to find an area that has a low delinquency rate, high capital appreciation rate. There are tools out there, you might not know about them yet. So that's why we focus a whole section on that. The fourth section is all about raising other people's money. So I can introduce you to some investors or take you to a few networking events where there are other investors present. Basically how to generate investor proposals, how to negotiate with an investor, how to set up terms, how to structure a deal with an investor. Legals and structures, so OTPs, setting up a company. I'll introduce you to my accountant. He sets up a company for you. We can talk about trusts. So essentially we spend a whole section just getting your business started. And then finally, number 6 is we look at the power team. So this is where I can introduce you to builders or to estate agents or to insurance brokers or to all the different people that you need within your property game to win, like a conveyancing attorney, for example, or a trust specialist or a tax consultant. All of these different people, because I've been in the game for the last 7+ years, I've been able to build a relationship and verify them. So here's just one of my students. His name is Nati. He came through our program, and the key thing that I just want you to read is that second sentence that says, my coach helped me complete 8 deals in 1 year using other people's money. Now, what I love about Nati is he's a hard worker, and he's not willing to let anyone else do the sit-ups but him. And what he's done is he's taken charge of his life, and he's been able to do 8 deals in the space of 1 year. And he's not somebody that comes from a wealthy background. He grew up in a township in the Eastern Cape. He came to Johannesburg with the hopes of a better life, and he has done really well for himself. He works now at a bank, and he's able to look after his family, and he's able to pay his parents some money back home. He's able to send money on a regular basis, and he's able to look after his brothers and his sisters. And he's serious about wealth creation, which is great. Now, we do have 2 options. The one is one-on-one coaching. That's where you'll sit with myself, and we'll sit for 6 sessions on a Skype call or in person if you live in Cape Town, and we'll go through those 6 sessions. This is really intimate. It's really specialized. It's me, you, talking about your specific needs and your requirements. So it's very intimate, and it's very customized, which is great. Or there's also a group coaching opportunity. Now, the group coaching is essentially a new product that we brought in because the one-on-one coaching is quite expensive, and not everybody is able to afford that, whereas the group coaching is when we bring 5 or 6 people together to go through the 6 sessions, and they're able to split the costs, right? So it's less personal, right? You don't get the one-on-one time with the coach, but you do get to learn in a group setting, and it's not as expensive as the one-on-one coaching. Okay, so if you do want to know more, if you want to know, what the process entails for the one-on-one or the group coaching, you want to know what the costs are, you want to know how and when to get started, please just email me a direct email. That's my email address there. That's Lawrence@housebuyers.coza, LAURENS @housebuyers.coza. And just in the subject line, just put the word coaching. Send me an email and I will reply with essentially our brochure, which has all the information, the costs, and then you can make a decision from there. And maybe me and you can sit for an hour and just chat about what it is you're trying to achieve and see if our coaching service would be right for you. So we can do a free, obligation-free call, just answering some of your questions. So guys, I see the time is 6 o'clock, so hit the nail on the head. Sorry, just one more time. These are some links if you are interested. If you have any technical issues with the app, please email support@myapp.online. I know we've had some issues with the payment gateway. If you do experience any issues, please contact support. We are talking to the developer on a daily basis to try and sort that out. We're also having a discount for my property app for today, a 40% discount. So I think Kapolo will put a call to action now onto the webinar. Otherwise, I will send you an email after this webinar, which you can then use to get that 40% discount. Please go and check out our blog.mypropertyapp.online. We put a lot of content up there. We put our webinars up there. We've got ebooks, we've got blogs and articles. And if you've got any questions around investments or coaching services, please email me. So what I'm going to do now is stop sharing and take a moment to answer a few questions. So let me see here. There are quite a few questions over here. So let me start here at the bottom. Is the coaching limited to the 6 sessions? So no, it is not on. What I like to do is I like to do the minimum of the 6 sessions because that's going to get you the basics of the property game. If after the 6 sessions you feel you still need a bit more time, then we can decide on a session per session basis. For me, I'm happy to help people. That's why I do these webinars for free. I love teaching, I love educating. So if after the 6 sessions you still want to give me a call for 10-15 minutes, that's totally fine. If you start taking maybe a couple of hours of my time, then I might charge you for those specific sessions. Cool. I hope that answers your question. Then we've got Zanele. Hit the screen. Can't see properly. Oh, okay. Sorry. Yeah, we will be sending you a recording after this. So yeah, sorry that the screen was a bit small. We will send a recording after this call. Where did Leroy get a buyer? You're probably not going to believe me, but he got it on Facebook. So he just went onto Facebook, onto Marketplace, and yeah, that's how he was able to find a seller. Okay, what is an installment sale agreement in property and how does it practically work? An installment sale agreement is very common in a car purchase, right? When you're buying a car, you buy it for 200,000 Rand and you pay it over an installment period of 5 years, and every month you pay 5,000 Rand or whatever that fee might be. Same principle with property. Now, an installment sale agreement can pretty much be a loan from the bank, right? The bank gives you a 20-year loan where you make monthly payments that are the same for 20 years. That's an installment sale agreement, right? The installment sale agreement says that you will pay me 5,000 Rand for the next 20 years every single month. So an installment sale agreement is basically a loan. You just need to know what the period is, what's the term. How many years do I have to pay this back? What's the interest rate? Work out your monthly bond repayment or the monthly payment, see if it works in your numbers, and then you can decide if that financing is good for you or not. Okay, why would you do a partnership with your friend instead of a joint venture agreement? So partnership and joint venture agreements are one and the same. As long as you've got a good contract in place, then either one of those, it's pretty much just, it's the same word for, a different word for the same thing. Okay, what is the average monthly cost for keeping a trust? I stand under correction, but you're looking at about 1,000 Rand per month, depending on how complex your trust is. So yeah, about 1,000 Rand per month. Lungisa, currently I rely mostly on banks for financing my deals. I wish to know, after purchasing a new property, is there a specific period I need to wait before I approach the banks for the next deal? So Lungisa, that's a great question. The thing where people get stuck with getting loans from the banks is that they buy negative cash flowing properties. The bank looks at one thing. They look at your affordability. If your salary is 30,000 Rand and your expenses is 30,000 Rand, it means you've got zero income. Effectively, they're going to give you a zero loan. But if your income is 40,000, your expenses are 20,000, you've got 20,000 Rand worth of profit in your personal name, you can get a loan on that affordability. So my advice to you is make sure that you're buying cash flow positive properties. Where people get stuck is they buy a property that is losing them money every month, which means it reduces their affordability, which means they can get less money from the bank. If you buy a property that increases your income, you don't have to wait at all. You can go the next day to the banks and get another loan, because all the bank is worried about is how much your affordability is. So I hope that answers your question. MJ, can you find good deals online such as Property 24? 100%. Property 24 is probably where I do most of my hunting. I find almost all of my deals on Property 24. Go to my YouTube channel and you'll see I've done actually some live deal analysis. Or go check out our blog page. You'll see some of the previous webinars I've done live deal analysis where I've used Property 24 to actually find deals. So that could be quite interesting for you. Okay, we often refer to student accommodation and multi-lets as two different investment strategies. What is your take on having both students and young professionals in one property? Yeah, I think it's pretty good. What's nice about students is that there's a very big market for it, especially because there's not enough accommodation to meet the need of how many students need accommodation. What I like about professional tenants is they usually rent for 12 months, whereas students rent for 10 months. Because they take holiday November and December. So I actually prefer professional tenants. Students are nice if you're struggling to find a professional tenant, but if you can, put professional tenants in, I'd rather go professional. Okay, when can I use my active CC company to start my investment pro? Yeah, so I'm assuming that's a closed corporation. I have never worked with a CC because they don't actually exist anymore. So you might just need to talk to an accountant or to maybe a property attorney just to make sure. I'm happy to introduce you to someone if you need. But as far as I understand, you could start investing. Is there, what is required to change your property portfolio from your name to your company? Ooh, so Timber, that's going to be a tricky one because in order to do that means you have to sell the property from your personal name to your company name, which means you're going to pay transfer fees, which sucks, so that's why I recommend that the first deal or two you do in your personal name, but then as soon as you start trading, putting it into a company name, because otherwise you are going to you're gonna have to now basically buy your property from your personal name into your company name and pay the associated transfer costs, unfortunately. Okay, is it wise to invest using your own money? It comes down to return on investment, right? So I like to use other people's money as much as possible because I'll never run out of money if I'm using other people's money. If I'm only relying on my own money that I've got in the bank, it means that at some point I'm gonna run out of money. So for me, return on investment is key. You need to know what's the best return on investment, and number two, always try and leverage as much as you can because you won't run out of money that way. Do you think the need for multi-lets will reduce due to COVID and people wanting to social distance? I don't think so. I think this COVID situation is going to be a short-term situation. My girlfriend is a doctor. She works here in Cape Town, and they predict that the next 3 to 6 months are going to be hard. But once COVID is over, the economy is going to return back really quickly. So yes, we're heading for a recession, but the bounce back is going to be really, really quick. And I think within the next 6 to 12 months, things will normalize, and multi-lets is the answer because it's low-income housing. That's where the biggest demand is. What can you do to mitigate your risks of not receiving rent, as a lot of people did not pay rent? Yeah, sure. So MJ, great question. My philosophy has always been to put a lot of the money you make every month away into a savings nest. So to make sure that you're saving more than you're spending all the time. Luckily, I've been saving since I started my property portfolio, so I've got about 6 months worth of cash flow that I can tap into. I really recommend having 6 months always. If you don't have 6 months, try and get there as quickly as possible. In terms of now trying to mitigate your risk, you can apply for debt relief by the banks. You can apply for debt relief through your investors. I would say, other than maybe applying for a social grant or going to the government for financial assistance, you're going to have to try and let this blow over. Unfortunately, I don't know if there is a way to get it. Okay, so is it best to buy your first property in a trust or a company? Ben, definitely a company. Once you've got a portfolio and you're looking at giving it to your kids, look at a trust. Neo, how do I get into property as a young person without any money? I hope that you can start with the rent-to-rent strategy. I think that's the best opportunity for you there. Okay, Leona from Durban, interested in buying a house to live in post-lockdown. Okay, so she's looking for deals. Leona is looking for a deal, a townhouse in the Durban North area. So if there is anyone on this call that is a sourcing agent, estate agent, or someone who's looking to source deals to investors in the Durban North area, please send me an email. I will then introduce you to Leona, and hopefully you guys can further this conversation and get into some sort of agreement, which is great. Okay, Tian, is there still financial security in property in your view after COVID? What strategies are there to protect yourselves? So similar question to MJ. The property market is going to tank. 100% is going to go down. The thing is, people aren't going to be buying property, which means the property market will definitely take a downward turn. I think you're probably looking at a 15 to 20% depreciation of your assets for the next 6 to 12 months. Might even be 2 years. I always say buy for cash flow, right? Make sure that you buy a property that has monthly profit, because for the next 6 to 12, 18 months, the property prices are going to be low. It's not a good time to be a seller right now. It's a very good time to be a buyer. If you've saved some capital and you've been very good with your cash and you've got some money to invest, you're going to find bargains out there. So it's really a good time to be a buyer, not a seller, unfortunately. Okay, let's see here. Should I focus on a specific area to kickstart my property journey? Shalom, I would say so, because once you understand an area and you know sort of the market prices and the rental, you can analyze a deal much quicker. For example, in Rosettenville, I know that you're going to get 4,000 Rand for a 2-bedroom apartment. So if I'm looking at a block of flats that are 6 times 2 bedroom, I know it's 6 times 4, which is 24,000. I know the rental. So they just need to tell me what the asking price is, and I can work out whether there's going to be some sort of yield in the deal or not. So I definitely think start with one area and then start to progress from there. Would you sign an offer to purchase without viewing the property in this time? 100%. Sign an offer to purchase with a suspensive clause that says this offer is subject to me viewing the property when the lockdown ends. It's subject to a 2-week due diligence period. 100%. You can sign an offer to purchase now to secure a deal and still have an exit out. Okay, let's see here. Clyde, how do you suggest to go about subleasing legally to ensure a good relationship with the landlord? So Clyde, that's a great question. The rent-to-rent strategy works very well, but only if you get the owner's permission. So pay for a really good property attorney, get a good contract in place, play open cards with your landlord, and make sure that you guys are both signing the same agreement and you both know what the relationship conditions and terms are. That's the best way to go about it. Those deals, by the way, the rent-to-rent is probably the best deal in terms of there's very little risk, little capital up front, but to find a deal like that is hard. Definitely. For area research, should I use Windeed, TPN and Lightstone, which is better? TPN for me is a must. I love that solution. It's great for any rental information. Between Windeed and Lightstone, not much of a muchness. I like Lightstone just from a visual point of view. I find that their data is just presented in a nicer way, but I know Windeed is a bit cheaper if I'm not mistaken. So have a look. I would recommend TPN and Lightstone if I had to, gun to my head. Do you ever check zoning of the property when you buy a standalone property for multi-level student accommodation? Lungisa, I always check what the zoning is when it's a student accommodation property. Definitely. You need to make sure that the property is, registered for multiple people, or at least as a commune, because otherwise, as soon as you buy that property, the municipality is going to come and shut you down because you don't have the relevant certifications. So great question. Definitely check the zoning. Imran, where can one find properties below market value outside of Property 24 auctions? I would say Sheriff Auction is a great one. Go check out our website, sheriffhq.coza. Great place to start with auctions. I joined very late. Can I get a link to the presentation? Yes. So Veya, we're going to send you a link tomorrow. So you can go and check out the whole video tomorrow. Okay, 5 more questions. Is there a way of analyzing stand deals? Do banks finance stands? I'm assuming you're talking about land. I think they will. To be honest, I've never done that strategy before. I've never bought vacant land before. You know what? If you send me an email with this question, then I can just respond to you via email, and I'll go and talk to one of my colleagues. Honestly, I've never done it. My understanding would be, as long as the bank can see value and justify value on the land, why wouldn't they loan it? It's an opportunity to start a business, so it's essentially a business loan. Okay, how to get your first property. So Precious, I hope that you've learned how to get started with this webinar. Okay, Spungile, also I've answered that. How do I start without capital? I've also answered that one. Okay, should I go for free title houses or apartments or flats as a beginning investor, I'm assuming? I'd probably go apartments and flats just because they're cheaper, so get your confidence going with 1 or 2 smaller deals, and then, obviously with a smaller deal, if you make a mistake, it will obviously reduce the risk. So I would, say start small and then build yourself up. Then we've got James. Hi, Lawrence. May you touch on zoning council consent required for multi-lets, say a single residential dwelling with 6 self-contained units. So James, send me an email because that's quite a long answer. Essentially, you'll need to speak to a town planner in the area to be able to get the zoning rights and the consent. When you're looking at multiple units, you need to be getting various residential zoning rights. So you'll need to be, zoned for Res 2 if you've got 6 to 12 tenants. So it gets quite complicated. The basic principle is make sure you're talking to a town planner or an urban developer within the area, and they should be able to answer you. Okay. So I hope that's it. And then we've got a question here from Ben. Do you do developments? So yeah, Ben, I have actually I started my first development about 1.5 years, 2 years ago. It's happening in Europe, in Belgium. That's where my parents stay, and the financing options there are really, really exciting. So I do have a bit of experience in developments, 100%. So guys, I think that is the questions for now. I'm sure that more questions will come as and when you guys get them. Please feel free to send me an email. And yeah, I'm hoping that some of you are also interested and serious about the coaching program and want to start the journey with us. Until next time, happy investing, and I'm sure I'll catch you soon. Thanks, Ed.